understand. Yes, absolutely. Yeah. Right, we will start in a minute.
Yeah, CA Middle Adhya. Is there anything particular that you have raised the hand? You have anything particular question?
No,
She's
no, no, no.
to join.
Hi, good evening, everyone. No, nothing particular, but yeah, mainly the applicability to the free zones and the transfer pricing. So yeah, in general only
Sure,
everything.
we are
Thank you.
planning to have one of those sessions very soon in future. Sure. Right. We will. It is 6:30 in UAE and 8 o'clock in India for sure. I guess these are the only
Yeah.
two countries where people have joined. Good evening, everyone, and a good late evening for people in India. Thank you all for joining today in the globalized economy. Of course, like where the transactions have moved in all the countries. People from all the countries transact in all the other countries, right? So in this atmosphere, we are all thrilled to have you all, and we are all happy to have you to discuss more about this international taxation and explore significant benefits out of this uh, double taxation avoidance agreements. So, which forms part of the critical transaction costs and everything because each person is transacting in other country. Obviously, his taxation is also decides the transaction, right? So it should not be a hurdle for business, hampering the growth and hindering the ability to compete in an effectively global market, right? So in that background, today we are discussing more about double taxation avoidance agreements because it plays a pivotal role in mitigating the adverse effects of double taxation. These are so effective that your entire margin in your transaction might get affected, and this might even impact you so that you will take this transaction or not. So that kind of impact is there in each particular article which we are going to discuss right now. We have our eminent speakers, Satya Bharat, who has played a pivotal role in this. It is one of his favorite topics because it impacts the transaction a lot. So he is also, of course, he's a chartered accountant. Many of us here are chartered accountants. Mr. Ashish is like our godfather for this entire presentation. He has qualified in 2003, well versed in many industries in across UAE and India. I am Hari, by the way. I am a chartered accountant as well. So I qualified in 2009. So I'm also aware of this taxation in various countries, particularly in Gulf and in India. So I now request Mr. Satya to take the podium on and discuss each article in detail about direct tax avoidance, double tax avoidance agreements, and give its effects and impact on each particular transaction and how it impacts our daily life as well. Over to you, Mr. Satya.
Thank you, Mr. Hari, for the detailing. I take the permission of everyone to keep it on mute, so I'm muting all. So just for the benefit of the others. Okay. So now, hope everyone must be having a fair idea. UAE came up with the corporate tax, but then we are not taking the core UAE corporate tax in this webinar, but then in the future webinars. Now our target is to understand UAE, in spite or despite of having corporate tax rolled out on 1st July 2023, but then there are something called as double taxation of avoidance agreements that were entered by the UAE government since 1970s, 80s, and 90s. If you take as an example, there is a double taxation avoidance agreement between the India and UAE in 1993, where there was no taxes in UAE, but still it is always between the countries they are mandated to have some kind of tax treaties. So, for example, UAE has approximately around 90 to 100 countries. They already have the in place. They already have the tax treaties in place, even much before the corporate tax came into the picture. So today we'll be taking you through almost at least 70 to 80% of the articles and outlining the double taxation avoidance agreements. We are taking the example of India and UAE double taxation avoidance agreements. So I'm sharing my screen so that we will take you through one by one. Hope my screen is visible to everyone.
Yes, Satya, please.
Yeah. So why we are now more concentrated on the DTAA? Corporate tax law, UAE corporate tax law, of course, Indian Income Tax Act 1961 also, they have their own set of provisions inbuilt in the respective law stating that my corporate tax law will be have no superseding. Like for example, if there is any international agreements that will supersede the respective countries taxation law. For instance, if I take UAE corporate tax law, it says article number 66 international agreements. So if there is any international agreement that is in place, that will be superseding the provisions of the corporate tax law. So whenever there is a international transaction, it is not just only you have to go with the provisions of UAE corporate tax law, but you have to read it together with the double taxation avoidance agreements and MLI. So we will be seeing what is MLI double taxation avoidance agreements in the next few slides. So international taxation will be giving you some essential funda. So these are the terms that you should be aware of so that it will be easy for me also to take you through. There are certain technical terms that you should be aware what exactly they are. You must be aware of it or you must be knowing it, but then we are just trying to simplify it so easy that people can able to understand it. So DTA starts with the double taxation avoidance agreements, BEPS, base erosion and profit shifting. So we are trying to focus why such words have come up. MLI, multilateral instruments, shopping. What is a treaty shopping? Contracting state, other contracting. These are a few things that we are going to take you through. So most of you might be already having some idea what is a double taxation avoidance agreement is. It's a bilateral agreement. What is unilateral agreement? Only when one party is doing a particular thing, it is a unilateral. Bilateral, two parties have agreed and coming to a particular agreement is a bilateral. Multilateral, where more than two, for example, 10 or 20 or 30 countries together, if they are agreeing on something, for instance, if we take G20 countries, Great 20 countries, so if they are all agreeing together and coming to a particular agreement, there is a multilateral agreement. Generally, double taxation avoidance agreements are between two countries, so that generally called as a bilateral agreements. The purpose of the double taxation avoidance agreements are mentioned in the respective preamble. So preamble is something, for example, if you take any act for that matter, be it Indian Contract Act or you take any act, there will be something called a preamble. Or you can also take it from the generally all the laws of India will be pronounced in the parliament. So even in the parliament, they will be mentioning what is the preamble, why we are bringing this particular act, why we are bringing this particular law, what is the purpose of it. So that covers in the preamble. So we will be taking you through what is exactly the purpose of DTA and all. But just to understand, this is a bilateral agreement between the two countries. Why? What is the purpose? Before taking this example, can someone tell me what is the tax rate in Canada? Anyone has some idea like what is the tax rate in Canada? You can unmute and you can just answer and you can mute it back. Okay, so the general corporate tax rate in Canada is about 40%. In India, now it is 25%, but approximately surcharge and altogether around 27, 28%. So let us take it as a 30%. If you are earning some income in your resident company of India, earning something from Canada, if both the countries start taxing it, say 40% they are taking from it and 30% taken by the company, by the India, so 70% going to the taxes, you will be left with 30%. Do any business will be interested in doing a business for just 30% while they need to pay 70% to the respective governments? No business will be interested in doing it. So to avoid such double taxation, two countries should not be taxing. okay, fine, you let two countries also tax it, but there should be something what is a tax credit. So these are the things why the DTA has come up with. They are ensuring the business focusing on getting the right piece of their cake, not that two governments taking the money left and right. So that is the very purpose of it. So I have taken one small example to make it sorry. Yeah, to make it more easy. ABC LLC Dubai has investments in the Netherlands. So a Dubai company is investing in Netherlands and made an interest. So now Netherlands has a 25% tax rate. UAE want to tax it at 9%. So total 34%. If they pay, then there's no meaning like it's just like two governments are taking their own piece of cake. So what DTA comes into picture and says, let us see first without DTA. If there is no DTA, there is no DTA rule or such. Taxability in Netherlands is 2.5 million, in UAE zero point 0.9 million overall. However, as per Article 47 of UAE corporate tax, there is a foreign tax credit. You can get a tax credit of 9% of the income. Whatever the tax that is paid to other country, you can just get the benefit. This is nothing to do with the DTA. This is the provision that was given by the UAE corporate tax itself. Similarly, there is something called Section 91 in Indian income tax. So this is called as unilateral, meaning, see, for example, there are around 192 countries. The UAE has DTA with only say like around 90 to 100 countries. So balance still more 100 countries are there where there is no DTA. In such cases also, the taxable person can enjoy this benefit of foreign tax credit. Whenever there is a agreement, you have to refer the agreement. If there is no agreement with the country, you can take the shelter of foreign tax credit 47, Article 47. Total taxability in Netherlands and UAE minus foreign tax credit, still you have net tax is 2.5 million. But when there is a double taxation avoidance agreement, and if DTA says only residence country has to tax it, then you will end up paying only 0.9 million. So that much of difference is there in the tax payout. Hope I'm there on this. I'm going to
Here,
the next point. If you have something, you can please.
just
Yeah,
to enlarge what Satya is
you can
saying, that
unmute and you can ask us.
yeah, just
Please go
to
ahead.
say what Satya is saying, he means that if we are having a DTA where DTA is saying that in Netherlands we don't have to pay tax on this particular income, then in Netherlands there will be no tax. So whatever the taxability of Netherlands, that will be superseded by DTA, and at the end of the day we are paying only UAE tax. And as per the UAE tax, we are paid zero point 0.9 million as compared to 2.5 million, which we are paid before. So there is a saving of 1.6 million due to application of DTA. That's what DTA helps us about. Yes,
Okay.
Satya.
Okay, now the quick question. Most of us must be a chartered accountants, might be auditors and all. So whenever we prepare an auditing report or any agreement or any quotation, we don't start everything from the scratch, right? We must be already having some kind of format in hand, and we will use that and we will change the names, maybe the period, the financial year, and a few here and there notes to accounts and all, right? So same is the case with the double taxation avoidance agreement. So there are in place, there are something called as model tax conventions. So there are three sets of model tax conventions. There are some three drafts already given. Mostly whenever the countries are preparing a DTAA, they will take either of these one, either from these three, and they'll just add their names, their country names, and they'll slightly customize here and there. So there are three model conventions. One is by OECD model, UN model, and US model. So OECD stands for Organization for Economic and Cooperation Development. So they have given one particular draft. That generally this draft is used by the developing countries like UK, maybe Japan or Singapore and Germany. So those countries generally use this draft as a base. Then there is a UN model and US model. Okay, so the moment you take it UAE India, it is generally falls into the ambit of UN model. UN model is generally used by the developed country, developed and developing, or both are developing countries. Between two developing countries or one developing and one developed countries. That is how the schema goes.
Mr.
US model is
Sivaraman,
specifically
one minute.
uses
Yeah,
whenever.
1 minute. Mr. Sivaraman, request you to please mute your audio.
Okay.
It's
Yeah.
okay. Go
So
ahead.
now
Go ahead.
US model. Yeah. US model is whenever you any country that goes to US and want to make a tax treaty, they have already a set of draft. Only you have to follow only that particular US model as a base agreement. Hope you got a clarity. Generally, if it is between two developed countries or one developing country, UN model. Between two developed countries, OECD model. If any country going with a tax treaty with the US, it is a US model. That's a base agreement. So there they'll customize it.
Yeah, Adhya, you want to
So
ask
I'll just
something?
yeah, please.
Adhya?
No, 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 no.
Okay.
I'm
Okay.
okay with
No
everything.
shit.
Thank you. Yeah.
Okay. So this is a high-level board's eye view. You can see on the left side OECD Model Convention 2017, on the right side UN Model Convention 2017. You can see the titles more or less the same, but when you go to the actual in the content of the articles, then you will find the differences because the generally OECD rule, OECD model more focusing onto the residence base. So if you are a resident of a country, okay, let that country take the tax. While UN model more focusing on the source, so the source country, the income from which country they are making the money, so that country has the right to get the tax. So that's how the focus will be slightly different. Here and there, the names will be same. Like if you see the article number one, both are giving the same title: persons covered, taxes covered. So this is the base, and from there, the governments make the customization. Now, base erosion and profit shifting. Four words: base erosion, profit shifting. So we are now trying to break it each one to understand what is this base and how it is getting eroded and how why we are now talking about this. Generally, these are set of planning strategies that a multinational company use to exploit gaps and mismatches in tax rules to avoid paying tax. We are just trying to take a very simple example. A Mumbai-based company is setting up a subsidiary company in Zavza Jablali Free Zone. Okay, I'm repeating Jablali Free Zone because I want to pose a specific question to the team or whoever from UAE. Okay, what they are doing generally, this exercise is having some IPR intellectual property rights. For example, they have some kind of intangibles, some brand value and all. Instead of registering in India, what they are trying to do, they are registering in the UAE in a particular free zone. What is the purpose? Because as and when there is a sale, they will pay royalty to their own UAE company. Why? UAE has only 9% corporate tax rate. If the same thing registered here, there is no advantage what they are going to get. So I'm repeating. So XYZ has some intangible. Instead of registering in India, they are registering in UAE so that UAE has a 9% tax rate and India has around 27-28% of tax. Now they on every sale, once they register this IPR in UAE company, now they are paying 30%. Whatever they sell, whether in India, whatever the Mumbai company is selling to another Mumbai company or maybe to US company, 30% straight they are transferring to Dubai. Okay, as a royalty. They are naming it as in the form of royalty. Tax rate in US 9%. Tax rate in India is 25% or plus surcharge and others. So now tell me, I have a quick question for those enthusiasts of tax in corporate tax in UAE. Is it a qualifying activity or excluded activity? Can someone please try to answer this? IPR held by a company in Zavza making money from India. What do you think? Is it 9% taxable or is it qualified activity so they can avoid the tax? Anyone?
Non-qualifying Satya.
Satya has already
Yeah.
given clue in his question.
Non-qualifying.
Yeah, it's an excluded activity. They very specifically mentioned the last but one point. If you are owning ownership or exploitation of the IPR, if you are making some income from the exploitation of the IPR, that's an excluded activity. So excluded activity, whether you do with another free zone company or rest of the world, wherever you do, it is an taxable income. So you have to pay the tax. Now XYZ Private Limited, what it has done, what if you see in nutshell, XYZ Limited Mumbai, it's tax base in India. Tax base here, base means tax base. It is eroding it. I mean, it is reducing the tax base in India and shifting the profit to UAE. So the base here is the tax base, erosion of the tax base in India, and shifting the profit to UAE. So that's how the terms have come up. Okay. Now BIPS means it's a activity of doing shifting your profit. People have seen it, like how multinational companies or anyone for that matter doing it. Then the G20 countries and OECD, the countries who are part of OECD. For example, UAE is a part of OECD. India is a part of G20 countries, G20 countries. So India is not part of OECD. So both of these G20 and OECD have decided, okay, let's make some action against the BEPS. Whoever doing the base erosion and profit shifting, let us take up some measures and try to avoid this such kind of profit shifting. They come up with 15 points, 15 action points. Okay. So I just classified into four broad categories, all these 15, basing on the logic, basing on the purpose, the coherence, the logic, substance, transparency, and horizontal. I'm not taking this one. We may be planning another webinar on the BEPS action plan. So I'll just take only one point, action number 2, because this looks very attractive. The name is neutralize the effects of hybrid mismatch arrangements. Okay, the next questions are for those UAE corporate tax enthusiasts. So I want them to answer because we'll try to explain how action 2 is going to take place. Okay. HMA hybrid mismatch arrangements means exploiting a difference in the tax treatment of entity so and so. Okay, now I have a question for those who are the UAE team. Uh, you have invested, for example, you are a company in UAE and invested in a compulsory convertible bonds in India. Just give me a minute.
Now, why this has become so important is the BEPS is also the base for the transfer pricing rules as well. So since that has gained a lot of importance, taking advantage of direct DTAA and moving on will help a lot. So that is why DTA has gained a lot of importance over a period of time. And of course, corporate tax in UAE has also given that advantage of taking benefit out of the DTA and pay lesser tax, and also be compliant with all the legal rules. Yeah, take over.
Yeah, I'm sorry for that. So, like, I hope most of the people knowing about the participation exemption, right? Participation exemption, if you are having more than 95%, sorry, if you have anything more than 5% investment in another company, and if you are getting any dividend from that company, is a participation exemption, and you don't need to pay any tax on that. This is as per the UAE corporate tax. When you read the recent notification, they have made it very clear. If IFRS 9 classifying a particular investment as a equity, that is also fine. For instance, let me take IFRS 9 one example. If I invest in a compulsory convertible bonds with a fixed number of shares, which can be, I have bought a compulsory convertible bond today. After 5 years, I'll get a fixed number of equity by conversion. As per IFRS 9, it is a equity. You have to classify it as an equity in your books of accounts. I mean the issuer. So what are the interest? Since it is a bond, it is an interest what they pay to me. But then UAE corporate tax says, okay, fine, it is an interest, but then I assume it to be a dividend, or I'm going to give you an exemption. Because ultimately, as per IFRS, it is an equity. So I don't mind whether it is interest or dividend. You are getting in UAE an exemption for that. While in case of India, I don't mind what IFRS says. For me, if it is an interest, it's an interest. I'm going to give you deduction. So Indian company is enjoying the benefit of
Just the
interest
participants to
deduction.
keep on. There's a lot of disturbance in audio. Participants request you to keep your
Okay. So on one country, the same income, it is not considering it as an income, it is giving the exemption, while the other country is considering it as a dividend. So that is something like a mismatch. So there is a hybrid mismatch arrangement because of UAE corporate tax is more relying on the IFRS, while India has its own set of taxation procedures. Okay, second example. In UAE corporate tax, it says unincorporated partnerships. For example, there are two unincorporated partnerships. Unincorporated partnership, they have two choices. One, you take the tax individually at your level based on your profit sharing, or you apply to Federal Tax Authority, saying that I want to keep this unincorporated partnership itself as a register itself as a taxable person. Hope everyone know there are two choices for the unincorporated partnerships. That company is called, that particular entity is called a transparent, meaning you have a choice. It can be directly taxed in the respective partner's hand, or you can create a different company altogether. So transparent, you can take it like a transparent, or you can keep it like opaque. Opaque means as such as a separate taxable entity. Now let me take an example what how people can do it. Okay, this is one tip if you want to take it. You have an Indian company and a holding company. Sorry, you want to do something in India, like you want to make some kind of project in India. Uh, you create a company in UAE, a headquarter company, okay, a holding company you create there, and create a subsidiary company in India. Okay, let holding company transfer say like 10 million dirhams as a working capital on a loan basis. Okay, let management control of this subsidiary company happen in UAE. I'm repeating, let create a company in UAE, a holding company. This is not a tax planning avoidance or anything, just I'm saying an example. Please don't take it other way. So you have created a holding company in UAE and a subsidiary company in India, and holding company given a loan to Indian company. Okay, management control of the Indian company subsidiary is happening from UAE. So what UAE says, since management and control is place of effective management is from UAE, even the Indian company is also part of, it's a taxable residential person in UAE. Hope everyone knows that. POEM. As per the POEM rules, though it's an Indian subsidiary company will also be considered to be a UAE taxable person. Number two, you can also form a tax. Okay, you can also form a tax group. You can apply to the Federal Tax Authority. Because of this particular POEM rule, my Indian company is also a taxable residential person in UAE, and I want to club in my tax group. Yes, that is allowed. But I'll come to you like how they overcome this situation. So what you are doing now, you have given a loan to Indian subsidiary and it is paying interest. Okay, in India, this subsidiary is independent. They don't see as a tax group. So they are giving the benefit of this interest. What are the subsidiary paying to holding company? It is enjoying the benefit of interest deduction. When it comes to the money comes to UAE government is saying it's a tax group. So when you say tax group, we will eliminate the intercompany transactions. They don't see this as an income. This is just from one pocket to other pocket. So your income is not getting taxed in UAE, but then you are getting the benefit of interest in India because of the tax grouping provisions. Am I clear in my two examples? One is because of IFRS. Second one is because of the tax group provisions. Anyone has any questions on this? Okay. Now action
Nice.
two says. So yeah. So action two says, because of this point, this kind of neutralize the effects of hybrid mismatch arrangements. What UAE is doing now, let me take the first example. First example is subsidiary. Indian company, and the Indian company is a subsidiary paying interest to UAE company, and they're trying to form a tax group. If you see the actual rules, they have added one provision also saying that, okay, fine, management control is from UAE, so it's a taxable person in UAE. I'm okay to form a taxable tax group for both of you. I'm okay. But get me one more letter from the Indian government saying that this subsidiary is not a residence of India. Just like a tax non-residency certificate, DRC, right? Something like that, tax non-residency as good as Alexa. They want some documentation proof wherein this particular Indian subsidiary company is not getting assessed in India, which you cannot get it because of the Indian taxation rules. So that way they are trying to close that chapter. So you cannot form a tax group there. Let me come to the second example: compulsory convertible bonds. UAE is considering as a dividend. Indian tax laws considering as interest. When you go to UAE laws, it will also say, okay, fine, I will not going to tax you on this dividend, but then you have to ensure this dividend is not getting allowed as a deduction in other country. But in India, it is allowed as a deduction. So this way, they are trying to close everywhere. Wherever there is a loopholes, they are trying to close it up. So that's how I can take it up. Any more discussion that you want on this, or I can go to the next one. Anyone has any questions?
So, in a nutshell, wherever there is a difference of treatment of particular line item in India or wherever two countries are involved, so there comes the DTA or neutralizing hybrid mismatch agreements, whereby these impacts are nullified, so that both the base is not eroded. We get the total tax is paid on the total income. That is what this hybrid mismatch is all about.
Yeah. So next comes to the MLI. MLI, see, as we have discussed previously, Indian UAE DTAA have been entered in 1993 with lot of this base erosion, profit shifting. So these are the things that people are not knowing of at that time. So the DTAA was very much old enough to handle the current scenarios. So what people have done, like all the OECD and G20 countries, they entered a action number 15 is multilateral agreements, multilateral instrument. I can simply word it. So all